New supply in the apartment market has been a big conversation, and that is because new supply has wreaked havoc on performance in certain markets and pockets that are oversupplied. And this is a situation where you have a lot of developers who built a lot of apartments in a short amount of time, and it really disrupted the natural supply and demand equilibrium in those particular pockets or even markets as a whole. Think Phoenix, Austin, Charlotte, things like that, where there's just so many apartments that were built in that 2022 era that there's so much competition for the same pool of renters by all these new properties. So they offer concessions and they battle it out. It's a race to the bottom by way of lower occupancy, lower rents, and higher concessions. So that's the reason why we spend so much time focusing on supply when we are looking at potential acquisitions. So we want to look at what is the 3-5 mile radius in terms of apartments that are under construction that are going to compete with our subject asset. What are the properties that aren't under construction yet but are planned? So there's permits, there's planning, and things like that. But beyond that, because that just tells you what the supply picture looks like over the next couple years or so, you want to look at the structural supply constraints in that particular pocket. And obviously real estate's very micro, so when we're looking at a deal, we're looking at the particular neighborhood, the particular submarket, and we want to look for different supply constraints, such as, for example, the most obvious and classic supply constraint is geographic. So think New York City, think California on the coast. Those are classic examples of where supply is constrained because you just don't have more land to build, right? Manhattan is an island and there's only so much beachfront in California. So geographic constraints are a big one, and it's not the only one. There's also, there's also economic constraints, and there's also political constraints. And funny enough, New York and California have really the political constraint in a big way. And so what that means is there could be state level, city level, so local government type processes that make it very difficult to get permitting through and entitlements, and so it really discourages development or stalls the process and makes the process so long that it just makes the supply of new apartments very small as a percentage of the total inventory. So political constraints to supply are another big one. And then finally, there are economic constraints. So economic supply constraints are something to do with basically the rents in the area are too low to attract a developer to want to buy a piece of land in that area and spend the money to build, because they're simply not going to be able to charge rents high enough when they actually build their product to justify all their land costs and construction costs, right? So because developers are playing a spread game. They're buying the land, taking on the risk, doing the construction costs, and then they're hoping that at the end their property is worth more than all their input costs. And you need to have rents that are high enough to actually justify on a cap rate basis all your input costs. So that's something that we like to focus on a lot, is these Class B workforce housing type areas where the crime is low, the schools are good, the incomes are high, but the rents are still low to where developers are not too excited to develop there without some sort of tax credit or incentive to do so. If you're looking to learn more about our supply-constrained investment strategy and invest in one of our next upcoming deals, click the link in bio.